we'll move forward with Giles. Thank you, team. And
cheers,
Thanks,
guys.
Dale.
you
Thanks,
could see all these guys in about 45 minutes on the Morning Edge. Giles, welcome back to F.A.C.E. How are you, my trading warrior brother?
I'm doing great, Dale. Really nice to be here with you all. So really looking forward to the session. Are you doing okay?
Yeah, doing great. Another year. Another year we're all a little bit wiser, and really looking forward to your presentation today and what you're thinking with what's been happening with a little bit of a different direction with risk over the especially really all in a week last week. And I know you even wanted to mention what you think is happening in China. So why don't you just take it away, Giles?
Oh, Dale, you're a star. Please do jump in with any questions you want to as I go along. I mean, the things I really wanted to look at was, first of all, I really wanted to look at gold. Now, I think gold's really interesting because you can see that it has 2 months of the year where it has really strong seasonal patterns. You can see here in August and January.
We're right now we're just seeing the F.A.C.E. Banner on the screen.
Okay, let me just.
You may have to do a new share to get your charts.
Is that
there you go. Got it.
Yeah, great.
Okay.
I use this resource by seasonality, and basically it's very good at looking at seasonal trends. And you can just see, everyone knows that January and August tend to be strong months for gold because of the demand for weddings, particularly in India around the summertime, and the demand for physical gold around the Chinese Lunar New Year. So if you I like to drill down to this. So I've already taken a long in gold and taken profit because I didn't have the conviction to carry on holding. And I'll just run through that sort of nice seasonal pattern. If you see, like from about 20th of December, you start to see the pattern develop.
Yes.
And then it goes through around the middle of February. And
a lot of highs have happened in February's, according to my memory.
That's what kind of the stats kind of really show. If you a little bit further on, you just take it there. You can just see, look, in the last 25 years, you've got 18 gains and annualized return of over 30%. So that strong trend for gold is there, and it's always one I always look for around the turn of the year because of the strong physical demand from the Chinese Lunar New Year. It's one of the world's largest human migrations, and one of the traditional gifts is to give gold. Obviously, in the Asian world, giving gold is not just a gift, but it's also a store of value. In the West, gold's often seen as decorative. You might have a lower quality gold, but in the Near East, it's a higher quality. So when you're giving that gift, it's almost like an investment for your family. So it takes on sort of more significance.
So has COVID and some of the lockdowns in China, Giles, affected that demand? I know they are shutting down certain cities and ports, and I don't know if they're traveling as much as they normally do during the Lunar New Year.
Well, we saw a report out last week where Chinese officials were advising against long-haul travel for the Chinese Lunar New Year. Now, we've had some breaking news over the weekend that there's been some Omicron cases found in Tianjin, which is a gateway city to Beijing.
Right.
Now, the concern here is not so much with the Omicron, but the concern is more with China's policy on handling COVID-19. They have a zero-free COVID policy. So in effect, the main concern is if there's a handful of cases in a city, the Chinese authorities can end up shutting down the whole city.
Would the Olympics have something to do with them even being more excessive about control, being less than a month away?
Exactly. With the Winter Olympics at Beijing, Tianjin's that gateway city, they're going to be very nervous. I could see this going one of two ways. So at the moment, they're obviously got that zero-free COVID policy. They don't want to, you're absolutely right, Dale. I think the fact that you've got the Winter Olympics coming, they won't want to mess around with their policy now. But at the beginning of last week, I read a series of reports on Omicron. And each one of those reports, and this is reports from immunologists, who were suggesting that it's definitely significantly milder than the Delta variant. So there was some studies done on Syrian hamsters by, I think, some French scientists, and they said that the Syrian hamster, it's a bad time to be a Syrian hamster, was recovering very well from Omicron compared to the Delta variant. There were some Japanese scientists that did some study of the deep cell tissue within the lungs of those people who underwent procedures, and they found that Omicron was replicating much more slowly in the deep lung tissue compared to the Delta variant. And there was also some indication from South Africa that the people who had Omicron and had been double vaccinated had very good antibodies for other COVID variants. So it was just a series of pretty, reassuring reports from the immunologist community. So I do think in time there is a risk here that the Chinese authorities say we're going to allow a certain amount of cases to go unchecked within the community. That's the best scenario for risk. That's the headline that I would like to see that would be great for going long oil, long the risk pairs, if you suddenly saw a reversal of that Chinese policy. So it's a headline worth just sort of logging in the back of our minds that if they do reverse that zero free COVID policy, it should be very positive for risk, because it's an admission and a recognition that the Omicron variant is much less dangerous than the Delta variant. I'm not sure how the Omicron variant is responding to the Sinovac, which is the Chinese vaccine. I haven't read any data on that, Dale, but that's another thing I'd really like to see, is how effective is the Sinovac vaccine against the Omicron variant. That could be another positive risk headline, or negative if it's not, effective at all, or very low efficacy, then that could be negative for risk. So it's a two-way kind of market, but the bottom line is that is impacting gold demand. Because I think if I was in China with this Omicron variant, and that you've got the potential to see family, but what do? Do you get that traditional gift, Dale? I'm not sure. You might think, do we wait another year? So I could see that impacting demand. But the real driver, that real headwind for gold, is the move higher in real yields.
There you go.
That's the real problem. And it comes, like everything at the moment, it comes back to the Fed policy. So you can see, I love the technicals on the chart, and I'll look at the real yields in a minute, but you can see like two opposing signals for gold that are virtually identical. So you have here on the monthly chart from June, July, August, you've got a false break of a Harami inside bar, typically a very bullish pattern. You can see here, you now have a very bearish pattern, which is the false break of a Harami inside bar on the November weekly candle. So you've got two opposing sort of price action signals, which to me kind of sums up where gold is. It's a market of indecision at the moment, because it's
compression
really
building.
Sorry, Dale?
Compression building on a formation like this.
Yeah, absolutely. We saw that attempt of a break here, just heading into the end of November, December. You see, that was a little symmetrical triangle pattern that was just building here. Do you see that one there? If you just drop down to the weekly chart, you saw that compression, break, and then false break, and now we're seeing that sideways movement. So I think the market wants to go at one direction, and at the moment it is this surge higher in real yields that's the major pressure for gold. Now I'll tell you what I've been using to really get my head around gold this in the last sort of year. It's when I see real yields rising in line with the dollar, that's when I tend to see the best moves in gold. So if you just look here, and if you look at, I'm using the TIPS bond ETF as a proxy for real yields. But when you see real yields rising and the dollar rising, which is in red, then you see gold definitely falling.
Right.
Similarly, when you see real yields falling and the dollar falling, that's when you see gold rising. So what I want to see to get a clear direction in gold And you can see if we just take off the dollar index, just take off gold, you see it's this surge higher in real yields, which is the near-term pressure on gold. So what I want to see is I want to see real yields and the dollar moving in the same direction to get a handle on gold. So if all of a sudden the Fed turned very bearish, Dale, that could be a great opportunity to get into gold for maybe a little bit of upside. And if we saw, the ideal scenario, that China reversed their COVID-free policy, then...
Can I ask you this, Giles? When you look at the dollar in red,
yeah,
after that straight line move it had, and it's been moving sideways since Thanksgiving,
yeah,
doesn't that smack more of a consolidation before one more wave to the upside instead of it being a topping type of pattern?
yeah. This is where I'm at with the dollar, Dale. You look at the end of the fourth quarter. We had expectations that the Fed was going to have to be more aggressive. We've now got the Fed. Remember, last year they had no interest rate hikes till 2024. They're now dot plotting 3 interest rate hikes for this year. They were just Fed fund futures are moving up towards 4. Goldman Sachs saying that they're anticipating 4 and a balanced runoff sheet in July. So that's why the dollar. I haven't been surprised to the dollar sideways, because a lot of that hawkishness has been priced in. Now I'll tell you what I was a bit surprised about. Not surprised with, but I was surprised to not see more dollar strength last week. So I think the fact that we've seen the dollar weakness is because the good news, a lot of the good news has been priced in. So what will take the dollar even higher? Even if they do move to 4 interest rate hikes this year, look at the COT position. And I was looking at this before I came on, and part of my role with Financial Source as a commentary analyst there. Look at the US dollar strength in the large speculators. So there's been a lot of bullishness priced in by large speculators into the US dollar. So some of that positioning may be a little bit stretched, which is why I'm seeing it move sideways despite the expectations with the last Fed minutes being a little bit more hawkish, balance sheet runoff happening quicker than the market expected, et cetera, et cetera. So the moment and also on top of that, if you look at the seasonals, and this is what I found very interesting, this is a great pattern. If you look at the dollar index, and if you look at the look at it over like sort of 51 years, okay? Do you see how at the end of December, Dale, it dropped so low?
Yeah.
And then you have exactly the opposite at the start of the year. You have the dollar index moving higher. Now, my understanding is that's due to taxation reasons in the US, that it's financially advantageous to move US dollars from US companies to daughter companies at the end of the year. And then once you've submitted your accounts and you've pleased the revenue department, then you move the dollars back from your daughter companies back into the US. So that's why I wasn't surprised to see some dollar strength at the start of the year. But I think if there was a reason for more dollar strength, the market would have had it. So the fact that we saw so little dollar strength, I think, was interesting. But of course, I think, as you mentioned before, Dale, at the start of this webinar, is the dollar does see strength in risk-off trading. So if we see some heavy risk-off trading come in, then we could see some dollar upside for that reason, if you see, rather than Fed policy with the old dollar smile theory.
Do you glean anything from the COT in gold? I was reading, I saw a video with Larry Williams. You know who he is, right?
Yeah.
Okay, so Larry says that if you ever see the commercials in gold being hugely net long, that's when you can mortgage your house and buy gold. And some of my mentees, I was talking to them, and they're not there yet. Some of the funds are moving, large specs are moving to net longs, but the commercials, I think, are still not short. Is that correct?
Yeah, no, it's not an area I'm aware of, Dale. It's not something I've looked into, but I'll look into that. That
All
sounds
right.
interesting. Often I look at the ETF demand,
Yeah.
and I'll look at
GLD.
I look at the
Yeah.
overall demand. Around this time of the year, I've just been using that very simple proxy of the real yields and the
Okay.
dollar. And obviously the expectations for real yields is going to be driving commercials.
Okay. All right.
So,
Interesting. Anything else you wanted to talk to us about besides gold and the
one more,
dollar?
one more pair I think is really interesting, New Zealand dollar yen. Now, first of all, this is a medium-term outlook. And I think medium-term, the outlook for New Zealand dollar Japanese yen upside is excellent. Near-term, the position is more tricky because of the risk-off trading and the bids we see into the yen. If you look at the purple line, that is just the bond yield spread between New Zealand 10-year bonds and Japanese 10-year bonds. And you can see that as the yield spread tracks higher, then so too does the New Zealand dollar Japanese yen. And bond yield spread is a good way of tracking central bank expectations and gives a good kind of shorthand for what markets are expecting between the two currency pairs going forward. So if you look at the moment, you see bond yield spreads are pushing higher, but the price is pushing lower. Now, the Reserve Bank of New Zealand, now this is interesting, because I expected, they are projected at their interest rate meeting before Christmas to raise interest rates to 2.6% by the end of 2023. They're currently at 0.75%. So they have nearly 200 basis points of interest rate hikes to come for New Zealand. Now, this is where it gets interesting, is that I saw one of the asides they made in their last interest rate decision. They did hike, but it was a more bearish hike. But they did say they were a bit concerned about wage pressure. And they could
it's happening everywhere.
Yeah, that's right, Dale. And if you think since then, look at the Bank of England's decision at the end of December.
Yeah, they were
surprised
gutsy.
Markets, with that 15 basis points. And what got them worried? I remember I was speaking to a Reuters journalist about this. It was wages. Because, if you think about it, I read this report, and this is what really sort of experientialized it to me, was when I looked at the perspective from a restaurant manager, and he was saying, look, I want to get my staff back, but in order to get my staff back, I'm having to pay them more. Right. So he's paying them more to come back to work, and they're saying, but now, because obviously it sounds obvious, but because I'm paying them more, I've got to increase my menu prices.
Right.
So I was thinking, of course, that's going to be the same across all of the United Kingdom. And the Bank of England recognized that and got onto it very quickly, because once inflation hits wages, the whole inflation problem becomes systemized. So it doesn't matter the fact that you've got there because of supply chain issues. The point is that inflation's here, and it's in the system because it's in the wages. We saw that in the NFP on Friday. Once wages start rising, central banks will be nervous. So this, for me, gives more emphasis to New Zealand dollar yen upside, because I think the next time we have the RBNZ meeting, when you consider they were concerned before people were getting concerned about wages, now that we've had the Bank of England, now we've had the Federal Reserve, now we're having central banks worry about wages, how much more will they be concerned? I think they're going to be even more aggressive when they do have their interest rate meeting. Now, of course, there's a number of different risks, and I haven't got time to go all in the different factors.
So, I mean, are central banks across the world willing to start a pretty severe recession to take away, instead of people being paid higher wages, to make them unemployed again? I'm trying to understand the end game, because if you and I understand that once wages go up, it's pretty difficult to say, well, I'm going to pay you less ever again. So what's their end game? I mean, and commodity prices too, Giles. I mean, you could raise rates 5 times. I don't think it's going to affect the size of bean or corn crops. Or whether or not there's going to be enough fertilizer to bring in another. So what do you think the end game is for these central banks tightening now after the horse is out of the barn?
Well, I think then they're going to have to cut back, aren't they? So
I think it's a question of hiking now as quickly as you can with as little pain as possible before you decide you have to hold. So
is their whole reason to hike now so that they have a cushion to bring them down again if they need be?
Dale, I don't see the alternative. I was speaking to a journalist at the LBC and he, in the UK, it's a UK national radio station, and he was saying, he was saying to me, like, we're addicted to debt,
Yeah.
And he's saying, when is this going to end? A kind of a little bit of a tone that was sort of saying, we're idiots for taking on so much debt. And what I wanted to say to him, Dale, was, well, look around your studio. Do you want to reduce debt? Because if you want to reduce debt, imagine 50% of the people in your studio lose their jobs. How would you feel about cutting back on debt then? So we can't forget the human factor. People won't be able to forget the human factor. So I think the only viable option that I can see that makes sense to me, Dale, is that one of hiking as quickly as you can with as little pain as possible before holding back and getting some kind of relief. That's just my opinion, Dale. And also that's a little bit of what I want to happen. That doesn't mean it will happen.
I'd like a jubilee.
Yeah.
I mean, there's a little biblical principle that worked for thousands of years. But what do you think about, when we're looking at this, Giles, Kiwi yen? I feel the same way about Aussie yen. I mean, they are cousins, similar.
Yeah, I feel the same way about the Aussie yen. And we did see like a really good move higher in iron ore prices and coal prices. Just see that this
Santa didn't have coal this year. He couldn't afford. Couldn't afford it.
Just see iron ore pushing higher and coal futures pushing higher.
Okay.
So all of that bodes well for us, the Aussie dollar. The only problem with the Aussie dollar, and it impacts New Zealand dollar as well, is obviously
China.
The Omicron risk for China.
Yeah. Well, Giles, another great presentation. Best way for our viewers, listeners to follow your work and stay in touch with you and get in touch with you?
Yeah, there's my blog here at HYCM. That's a good way to be in touch with me. There's my Twitter handle there at Giles Coughlin CCA. And I also have my own website at gilescoughlinfx.com. So you can get in touch with me any of those ways.
Okay, wow, nice. Okay, Giles, I really appreciate you coming to talk to us when you're talking to all these big guys, CNBC and Bloomberg, to come in to, our little venue and share your well-publicized views. I'm humbled.
Dale, it's my privilege and pleasure to be speaking with you and the team with so many years of experience. The honor is definitely mine, Dale. And so thank you very much for hosting me. I really appreciate my time here. And it's lovely talking with people who have such a great understanding of the markets. It's a very stimulating conversation.
You're the best, buddy. My trading warrior brother and my brother, Giles Coughlin. Follow Giles. As you could tell, he is passionate about these markets, and that's what it takes, because you have to be a hard worker to be on top and in tune with movements and leveraged ideas. So thank you again, Giles, for being with us.
Yeah, thank you, Dale. Speak soon. Bye.
We'll do it again. We'll do it again. I'll DM you later and we'll set it up. Okay.
Yeah, that's great, Dale. Look forward to it already.
All right, Giles Coughlin, everybody. Everyone's saying thank you, Giles. Appreciate it. Thanks for the ideas and discussion.
Oh, thank you.
And everybody, that'll be a wrap for F.A.C.E. You could join the team in 18 minutes on the Morning Edge. You do have to shave now to get in there to the Morning Edge. So use your edge and come in clean shaven. And the team will be breaking down the bias chart and continuation of what we're doing here in F.A.C.E. This is the tip of the iceberg for ForexAnalytix. So remember, don't just count your coins, your bullion coins, or your currency positions, count your blessings, and we'll see everyone tomorrow for Turnaround Tuesday. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.